As of the market close on Friday, December 19th, 2025, Supermicro Computer Inc., trading under the ticker SMCI on the NASDAQ, finished the session at $31.11 per share. This represents a substantial intraday move of plus 5.92%, with the stock gaining $1.74 during regular trading hours. The momentum continued into the after-hours session, where the price ticked up slightly further to $31.34. While a nearly 6% jump in a single day might suggest a return to form for this high-performance server specialist, the reality of the situation is far more layered than a simple green candle on a chart. If you look at the broader landscape of online investing right now, many traders are treating this move as a relief rally rather than a full structural recovery. The expectation among the retail crowd on platforms like Robinhood and SoFi Invest has been that Supermicro was effectively a falling knife, trapped under the weight of regulatory delays and internal accounting scrutiny. However, the reality we are seeing in the latest data suggests that while the paperwork might be messy, the underlying demand for AI infrastructure is actually accelerating in ways the market hasn't fully priced in yet. The most striking insight from this week's action isn't just the price increase, it's the massive shift in revenue timing that caught analysts off guard. People see a revenue miss, like the $5 billion reported against a $6 billion to $7 billion guidance, and they panic. But if you look closer, that money didn't vanish, it shifted. Supermicro recently revealed that several of its largest customers requested last-minute configuration upgrades to their systems, specifically moving toward the new liquid-cooled NVIDIA Blackwell architectures. This caused a temporary delay in shipments, pushing revenue from the first quarter of fiscal year 2026 into the second. For the patient investor using a self-investing strategy, this is a classic case where the bad news is actually a hidden indicator of future strength. The company has already confirmed design wins exceeding $12 billion for the current quarter alone. That is a massive figure that completely reframes the narrative from a company in decline to one that is simply struggling to keep up with an insatiable appetite for AI hardware. When you compare this to the relatively steady performance of something like Apple stock or the continued dominance of NVIDIA stock, Supermicro remains the high beta wildcard of the data center world. Most investors holding SMCI in their Fidelity brokerage or individual brokerage accounts have been conditioned to expect extreme volatility, but the current tension between expectation and reality is at an all-time high. The general belief is that competitors like Dell and Hewlett-Packard Enterprise are eating Supermicro's lunch while they deal with their auditors. The contrarian take, however, is that Supermicro's modular building block architecture and their early lead in liquid cooling are providing a moat that's harder to cross than people think. Traditional servers can't handle the heat of the next-generation GPUs, and Supermicro's ability to ship fully integrated liquid-cooled racks gives them a speed-to-market advantage that keeps their largest customers from jumping ship, even amid the corporate drama. In the last few sessions, we've seen institutional activity pick up significantly. While retail traders on the Robinhood trading platform often react to the daily headlines, the big players, the ones moving money into Fidelity ETFs and Fidelity mutual funds, seem to be looking at the valuation gap. With SMCI trading at a forward price-to-earnings ratio of roughly 15, it is currently priced at a steep discount compared to the broader tech sector and even its own historical averages. This suggests that the market is pricing in a governance discount rather than a business failure. In interactive brokers and other professional-grade investing sites, the trading volume has been consistently high, indicating that high-frequency traders and hedge funds are battling over these levels. The recent 5.92% jump was fueled by a spike in volume that suggests some of the short positions are finally starting to cover, perhaps realizing that the delisting fears that haunted the stock earlier in the year are beginning to fade as the company works through its regulatory regulatory filings. If you're managing your own portfolio through Schwab Intelligent Portfolios or a similar robo-advisor, you might not see these swings as clearly, but for those doing active online investment, the intraday volatility is the story. We saw SMCI open at $29.59 on Friday and hit a high of $31.24. This kind of range is typical for a stock with a beta of 1.74, meaning it moves significantly more than the S&P 500. It's also worth noting that institutional ownership still sits around 84%, which is incredibly high for a company that has been under such intense fire. Big funds aren't just holding. Some, like American Century, have been reported to be increasing their stakes. They're betting that the $36 billion revenue target for fiscal year 2026 isn't just a pipe dream, but a realistic goal based on the current backlog of orders. Comment below how many shares of SMCI you currently hold in your portfolio. Are you buying this dip or waiting for more clarity on the accounting side? To understand where we are going, we have to look at what Supermicro actually does. They aren't just a box maker. Their business model revolves around what they call total IT solutions. They design and manufacture high-performance server and storage solutions based on modular and open standard architecture. This modularity is key because it allows them to quickly integrate the latest chips from partners like NVIDIA and AMD without having to redesign the entire system from scratch. This is why they were the first to market with liquid-cooled racks for the Blackwell chips. While Tesla stock investors might focus on autonomous driving and Apple stock fans look at iPhone cycles, SMCI is the backbone of the sovereign IA movement, countries and massive corporations building their own private data centers to keep their data secure and their processing power local. The macro environment has also been a double-edged sword for the company. On one hand, high interest rates have made the capital expenditures required for massive data centers more expensive. On the other hand, the race for AI supremacy is so intense that companies are willing to pay a premium for efficient and ready-to-deploy hardware. This is where the Fidelity wealth management crowd starts to take interest. They look for companies that have a dominant position in a growing niche. Supermicro's niche is the high-end, high-efficiency server. Their liquid cooling solutions can reduce data center power consumption by up to 40% compared to traditional air cooling. In a world where electricity is becoming the primary constraint for AI growth, that efficiency is a massive competitive advantage. Looking toward 2026, the catalysts are clear, but so are the risks. The primary catalyst is the successful ramp-up of the NVIDIA HGX B300 systems. If Supermicro can prove that they can ship these in volume and maintain their margins, the stock could easily retest the $40 or $50 levels that analysts currently have as their average price targets. The risk, of course, is further delays. If the revenue shift from Q1 to Q2 becomes a revenue loss due to supply chain issues or customer cancellations, the credibility of the management team will be further strained. We're also seeing a shift in the competitive landscape. Dell has been getting much more aggressive in the AI server space, and they have a much larger sales force and deeper pockets for financing large deals. For the active trader using the Robinhood trading platform or SoFi Active Investing, the technicals are starting to look interesting. The RSI for SMCI had dipped into oversold territory recently, which often precedes the kind of bounce we saw on Friday. The stock is still trading below its 50-day and 200-day moving averages, which means the long-term trend is still technically down, but the narrowing gap between the current price and those averages suggests that a bottom might be forming. This is the tension I mentioned earlier. The market expects more bad news, but the reality of the earnings power is starting to exert upward pressure on the price. When you're looking for investment help or researching on various investing sites, it's easy to get lost in the noise of the accounting headlines. But if you strip that away, you have a company that is growing revenue at a double-digit clip in the fastest-growing sector of the economy. They have a current ratio of 5.39, which means they have more than 5 times their current assets they need to cover their short-term liabilities. That is a very healthy balance sheet for a company that some bears claimed was on the verge of a liquidity crisis. They are using their cash to build up inventory, $5.7 billion worth, which is a bold move that shows management is confident the orders are coming. If they were worried about demand, they wouldn't be stocking up on parts. The future outlook for SMCI is fundamentally tied to the expectation versus reality framework. The market currently expects management to stumble. They expect the $36 billion revenue target for 2026 to be revised downward. They expect the gross margin to stay suppressed at 11 to 12%. If the reality is even slightly better than that, if margins tick up to 13 or 14% as they gain operational efficiencies in their new Malaysia and Taiwan facilities, the stock could experience a massive re-rating. This is what the smart money on the Interactive Brokers platform is watching.